Alright, so continuing on the study, we'll go over here on this bar, which is short covering. Observe how the rally begins May 2nd and runs on the 4th, 5th is accomplished on decreasing volume. So from here, so this is the short covering, evidenced by the pullback, a lack of follow through, goes down, and now it's going to attempt to rally in it. 1, 2, 3, 4, right here. Observe how the rally that goes up from May 2nd to the 5th is on decreasing volume, showing that whatever demand exists in the expectation of a recovery from the former December support level is not willing to follow prices up. So here, it's not willing to follow prices up. That demand is not willing to follow prices up. Such support is more likely due to short covering than re-entry of buyers. There's just more short covering. Weak rally. The rally, which begins May 7th, showed that the bulls have exhausted their buying power. Okay. Bang, right there. That's your climax. When I mark that increase in volume. From the 11th, the downward march of prices is resumed and the volume again increases. So, bing, 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 bing. As prices go lower, volume trends higher, gradually higher. Point, short covering, lack of follow through, more short covering, climax, rally down, climax, confirmation, or hesitation equals confirmation, rally down, volume gradually increasing. Volume gradually increasing equals liquidation. Note the complete failure of any tendency towards hesitation or rally as the average touches critical April lows. April lows, this is the low. Any hesitation? Nope. By hesitation, he means like over here. Is it holding this level and going sideways, or is it reversing? Like, do you have a red bar and a green bar? No, it's just red bar, breaks out red bar, you have another red bar, and continues. Compare this action with December. A low point is recorded around 113 on January 2nd. So what is it? June 2nd. So this low is recorded with the close practically on the low. The only warning that the average gives us of an upturn from this point was a small downward progress in comparison with the previous day. So what does he mean? From this bar to this bar, there's a lot of downward progress. From that lot of downward progress, you have little downward progress on the next subsequent bar. Okay, with the previous day. The close price on Jan 1st was 114 and a half, and on the 2nd 113 and 3/8, even though there's a lot of volume. So again, heavy volume, lack of progress in the closes, and a shortening of the thrust. From this low to this low, you have a lot of thrust. From this low to this low, you have very little thrust. And close to close is very little progress, even though the volume has increased substantially. Telling you what, there's some type of buying, holding the market. This showed resistance, possible buying by substantial interest. However, the market had now been declining steadily since the high point of February 24th, when the average recorded 173. The price of 113 is therefore 60 points down, and means that prices have shrunk about a third from the high. from the figure charts of the averages and the position of the group charts and of leading stocks on individual charts and the action of our wave chart, we may learn that the danger points for the short is approaching. But for right now, we are judging the market by its own action. Alright? So here's the footnote here. Additional indications of the weak character of this recovery are given by the following. So what's he talking about? He's talking about, I think, this recovery or something. I think this is the recovery. Volume surge of May 8th, right? Additional indications of the weak character of this recovery. It's a weak pullback. How do you know it's weak? The volume surge on the 8th, which is confirmed as a minor buying climax. How is it confirmed? By the prompt loss of that day's gain over the next two sessions. So over here, you have a bar, strong bar. You don't know if it's a climax or not, but if you take a look at 1 and 2, that day's gain is lost. So, I mean, you just take a look at the red bar after it. Two, the average runs into resistance under the temporary supports of April 17 to 21. Where's the 17? Right there. So, as price goes up there, right, the average runs into resistance just under the temporary support of April 1721, resistance created by the offerings of buyers who mistakenly judge these lows to be the bottom and are anxious to get out even on the upwave to May 9th. Therefore, we have another selling opportunity in anticipation of resumption of the major decline, whatever. What's he saying? It went down and it went up. So they're buyers on these green bars. They're buyers there. So you mark that area. Why? Because there are buyers there. Those buyers, they thought they were getting a good deal or buying the lows. So you mark that area and you'll notice that this tested that particular area where the buyers were stuck. Alright, so just coming back to this. Additional indications of weak character of the recovery. So that's all he's doing is imagine this with a line right here, and then the volume, it has a short covering rally, weak volume, bang, reversal off of a resistance area. That's all he's saying. So now what happens? So the market suddenly reverses from June 3rd, recovers 9 points in the average and closes nearly at the top with a high-end close, with the volume equal with that of the 2-day sessions of heavy liquidation. We must somewhere during the session of June 3rd cover our shorts if we are still short. In any event, that should happen on the next day's open. Why? I mean, how do you know it's not just short covering? Additional reasons for such action are the pace of the decline, on May 17th or May 27th to June 1st became so sharply accelerated as to create an oversold condition, which is dangerous to shorts. It's oversold. So let's compare the short covering here with the move here. The difference is you have gradual shortening of the thrusts prior to this bar. Here you have accelerated movement, basically some type of climactic movement, hypodermic movement, and with a lot of speed, and then you get a big bar up. So that's one. Alright, it's oversold, creates a oversold condition, and then the buying comes in. The speed at which the market recovers the latter day's loss suggests this last phase of the downward movement is probably the nature of a shakeout. I guess we'll talk about shakeouts later. Anyway, the averages have shown no preparation for a change in trend. This is sudden change is like a hypodermic or heart stimulant. He suddenly revives. Of course, we all know that this change reflects the favorable sentiment of the President Hoover at that time, and good news. We wait. Where does he cover his shorts? He covers it. He just covers it after that accelerated oversold condition and the reversal. He covers it here, or he covers it here, wherever. All right. Okay. So we await developments in order to ascertain whether this bullish factor is sufficient to turn the tide. That is, turn the trend from bearish to bullish. With sufficient experience as foundation of our judgment, we know that violent changes in trend occurring within a few hours are not lasting. The close at the top of the third is itself indicates a further rally. On the fourth, there's a gain of 5 points, making about 14 from the low point. The volume is still high. Just follow through buying, that's all it is. That is, we have good progress on high volume. But on the fifth, the gain in the average is only 3 points. It's still a higher high, higher low. Even though close is less, you can seriously see the follow through. So, and the volume decreases a little, showing that the buying power is less. The volume shows that the buying power is less. Buyers are reluctant to follow up after such a steep rise. The close price is below that of the previous day, which indicates that the day's net pressure was greater than demand. So that's how he's reading the close, the net pressure. This looks as if the rally is over for the moment. On the 6th, there's a further loss of nearly 8 points, bringing the average down halfway from the top. A normal reaction on a reduced volume. On the 8th, after a small recession, the average runs up and closes at the top. Right there. Showing that markets met support at where? So that pullback, it met support. It recovers to 125, which is about 2/3 of the reaction. Although the volume is comparatively light, the speed of the rebound and the behavior just described says the balance is on the favor side. The speed of the rebound is just whatever. It's just the time and price, the big bar. So one of the things he likes is when it goes down, the recovery is 2/3 of the pullback. So it went down and then it immediately recovered 2/3 of the pullback on one bar with high-end close and good range and increasing volume. So he's saying that this recovery is good. From the 8 to the 15, a zone is established between 130 and 120. So this is 120, and then he established a zone over here, about 130. So you got a zone. You got basically support resistance. So from the 8th to the 15th, there's a zone. Support resistance. Well, the market, what is he waiting for? Is it going to work out of this zone? It will be on the upside or downside. Okay, as the rallying days proceed, we observe falling off in volume. What's he saying? Look, bar, 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 down volume, down volume, down volume, down volume is very less, right? It's not a bullish sign, so it's not ready to break out. Alright, I'm going to stop right here.